goals. However, with the advent of Robo advisory, digital platforms today that provide digital algorithm-based or driven financial advice have now come into play and have changed the landscape. The choice on how one wants to receive financial advice can completely make or break your portfolio. Do we take the traditional route, or do we choose a human financial advisor, or do we just opt for a robo-advisor, or do we do a mix of both? To shed more light on this, ladies and gentlemen, it's my pleasure to welcome on stage our power panelists. The stage is ready? Okay, here we go. Let's welcome them with a warm round of applause. CIO, Validus Wealth, Rajesh Cheruvu. CMD, Abans Wealth and Investment Managers, Abhishek, Bansal. Sir, are you okay? Vivek Agarwal, COO, Scripbox, and Gaurav Mashruwala, financial expert and author. And ladies and gentlemen, moderating this panel is financial educator and coach Mrin Agarwal. Let's put our hands together in a warm round of applause, ladies and gentlemen. And Mrin, over to you.
Thank you. Good evening, everybody. All right. So I think it's been quite a long day with a lot of panels, but I think we have something very interesting to talk about, which everybody's been talking about, whether you should do it or not. And I'm sure that most of you are going to agree with me when I say that over the last decade, it's been a decade of disruptive technological advances and declining investment costs for investors and their advisors, right? I'm sure you'll also agree when I say that the regulatory changes have almost collapsed investment costs, which is good for investors, but what happens to the advisor? When we started this millennium, we probably started with a handful of online platforms, but now you have a whole magnitude of platforms available. As a financial educator, I meet a lot of retail investors who tell me that their biggest concern is the access to financial advice. They could be partly to blame because they don't want to pay for advice. But I think there's a bigger systemic issue as well, where it does not make economic sense sometimes for the advisor to provide physical advice. In all this, you now have the new hybrid model, which is a channel where you can do a combination of technology and physical advice. And I think a lot of advisors have been embracing technology. So towards this, I'm going to first start by asking Gaurav that, while it's easy to say embrace technology, but probably we go back a long way in the sense that we've been in the industry for a long time. For a lot of people, it's not really very easy to do so, right? So what do you think, Gaurav, are the challenges that traditional advisors who were typically meeting customers and managing their money, what are the challenges that they face while they embrace technology?
Couple of things. One is, are all clients and prospective clients ready to use technology? Because many of them are not.
Yeah.
Number one. Second, a lot of people also want human touch.
Yes.
They want to see human face. They want to meet them face to face. Third, from a common independent financial advisor perspective, what happens is that the cost of upgrading on regular basis could be prohibitive. So there are problems at all the ends. While robo-advisor and technology should remain, most of us at back end, we do have technology. But at front end, when it comes to interaction, people also still want to meet us, talk to us, see us, as in the touch and feel. And hence both should survive, but majority of people would still want to talk to us, either on phone or on video phone, Skype, or meet in person.
Okay, that's good to know. Rajesh, I would actually like to ask you that where do you think technology plays a role in advising specifically? Are there predictive analytical tools that are available that can be used to advise customers?
Yeah, sure. I think technology plays host, I think, in the last 8 years or so. Globally, this Robo Advisory 1.0, now I think that has actually put most of the analytics in the hands of investors. But how to make use of these analytics and how do you do away with emotional biases or emotional noises and take an appropriate decision? At times, I think if you have excessive information, excessive access to the market, also actually prod individuals to do excessive trading or excessive action.
Now they have even more access from yesterday.
Yeah.
Right?
Yeah. You're seeing that. So with the combination of both the technology with the human interface, so what we are at our end, what we are trying to do is, I think, more than empowering investors with the technology, we are actually emphasizing more and more towards empowering our advisors, investment advisors and financial advisors, to have data, required data, and you bring in required focus, and instead of you have information overhang today. There are too many data points, what to focus and what not to focus. So I think that's where I think our technology platform actually provides the required emphasis and required focus to the advisors, so that I think what kind of actionables to be done at a given given point of time in a marketplace. So I think that's where I think we are actually using extensively the technology platform.
Okay. And Abhishek, coming to you, how do you think technology can be used to actually acquire clients in non-metros? Because I again see that there's a lot of focus in the metro cities, but when you really go to tier 2 locations, for example, I really don't see too many advisory firms out there. It's basically agents who've been probably selling them insurance and then now are selling them mutual funds. So how do you think that you can actually use technology to acquire, or let's say to advise clients in other locations? And of course, we're not only talking about using digital methods of communication, but beyond that.
So, before I answer about how to reach in the remote areas of India, because the financial advisors are all sitting in metro cities, let us understand India from a global perspective in wealth management advisory, if I can have 1 minute on that. The global wealth management industry is about $75 to $80 trillion. And the Indian wealth management industry, as of now, is about $500 billion. Now, in this $75 to $80 trillion wealth management industry globally, that is the asset under management, only $1.5 trillion out of that is managed by robo-advisors globally. And out of that $1.5 trillion, $1 trillion of that asset lies in US. So US is the front runner in the robo-advisory or the digitization of the robo-advisory or the wealth management, as you say. India's out of $500 billion of total wealth management, only $65 million is under robo-advisory. So forget about the remote. It is the Indian space is up for disruption. If you talk about wealth management being done by a robo-advisor or digitization of wealth advisory in India, as per Statista, all this data is from Statista, the Indian industry of wealth advisory on robo side would grow at the pace of about 30 to 40% CAGR. So in the span of 3 years, you would see this number doubling up. So that is kind of disruption that you can see. In the US or in the global markets, we are expecting a growth of about 20% in these numbers. Now that is huge. So we have to understand that still we are way, way behind. If you see India from the global perspective, where the total digital assets or assets under management under robo-advisory is about 1.5 trillion, we are only 65 million. Forget about remotes or forget about even metro cities, maybe we are not able to get there. So to get there, it requires high amount of financial literacy. See, to get a robo-advisor advising you, the investor also has to be financially sound, just a layman, because it requires a person to fill up large amount of forms and large amount of details about your preferences. You know, when you, because we have a wealth management firm, I'm from chairman Abans Group, we run a wealth investment management firm. So people who are not from financial industry, they just say that, you know what, I have this much amount of money, I just want them to grow. No, there is no money plant which can grow them. So this amount of financial literacy needs to kick in before, and not only, forget about the remotes, it has to kick in first in the metros. And that's where I believe this space is up for disruption, not only in India, but globally, where companies like discount brokerage firms can take the most advantage of it, like people like Zerodha or ICICI Direct, where they can link wealth advisory through their online discount broking platform, where they can give execution as well as advisory.
All right. So since you talked a lot about all the statistics on robos, let's come to Vivek, who is actually running a robo advisory. And I'm going to ask you the typical question that's asked always of robo advisories, that while you can give a very good online user experience, but one of the common issues with a robo advisor or a mutual fund platform is the fact that it does not do holistic financial planning, and it cannot tackle all aspects of a person's financial life. Like, for example, if the person has a loan, so to give him an advice as to what he needs to do with that. So how are you managing those aspects?
Okay, I think that's a very good question. So I think what we do at Scripbox is that we are looking at technology from a holistic picture, and we are looking at the entire life cycle of a customer. So let's say right from the inception, where the customer comes to our platform, we do his KYC, do risk assessment of the customer, what kind of investment that he's looking at. Then, we use technology for also, finding out the right investment plan for that particular customer.
Yes, but I understand that you're completely a mutual fund platform, right? So
Yes.
where does the holistic advice or planning come in?
So the thing is that technology will be used in phases, right? So in fact, if you look at it, let's say for instance, right now, if you look at the spectrum of services the customer is requiring. So customer typically, if you look at the financial products, the investments of customers in financial products itself is quite low. I mean, mutual fund industry or let's say direct equity penetration in the country is quite low. What we are trying to do is take these products to the customers who are yet not using them. So in fact, 70% of the customers who come to our platform are customers who are new. We can figure that out because we get to know that their KYC is not done. So we are actually acquiring customers who are very, very new to this, and they are just starting to build their, personal finance journey. I mean, if you come to think of it, in a personal finance space, there are probably 4 or 5 very important aspects. Investment is one part, as you rightly said. What kind of debt they are having, what kind of insurance they are having. These are other significant points. What we are trying to do for the customer is we are trying to start his journey with investments, and then we will obviously looking to expand our product portfolio, offer other products as well to the customers.
All right, so it's a product approach then. Now, one of the other concerns with robo-advisories is the fact that you cannot drive good investor behavior, which certainly you can do as a physical advisor or as an advisor who's meeting a customer. So what are some of the steps that you think a robo-advisory can take to drive good investor behavior?
I think that's, again, a very good question. In fact, if you look at data, we also see that, a lot of customer churn which happens. What we are using is, again, technology to reach out to our customers. We're using emails, we're using other means of channels like, WhatsApp, SMSs, and we are reaching out to the customer and with a lot of content. The whole idea is to, drive the understanding in the customer. And somebody talked about customer literacy, which is, I think, investor literacy, which is very important.
If I could just interrupt. So I think, one of the bigger issues is the fact that, for example, you still have a lot of investors who are driven by near-term performance and choose funds based on near-term performance, and that's probably why people are buying international funds right now. So how do you kind of, tackle those issues, or, because once the customer has invested, you can do something, but, how do you kind of tackle these sort of issues?
So I think what we've done is that we've taken an approach which is probably slightly different from the other platforms, which are like open platforms and anybody can come and purchase any fund. In fact, one of the few customer what you call like, people like to see the last 1 year returns and then invest. This is exactly what you're talking about. In fact, we've actually moved away from this. We have taken a curated approach of portfolio where we actually only let customer invest in a particular portfolio, and this portfolio is created by our experts. So we do a lot of data analysis. We look at only, let's say, large caps or diversified funds, and maybe just introduce maybe 5 to 10% of foreign equity into these portfolios. So we have taken a very different approach, which is more advisory led rather than just a platform where people can come and invest and whatever they think is the flavor of the season, invest only in that. So we have taken a very, very different approach here.
Okay. So Gaurav, coming back, obviously the advisor today, if they need to embrace technology, they need 4 tools, right? So they need an analytical tool, they need a planning tool, they need a reporting tool, and they probably need a transaction platform. How do you think advisors can go about choosing this, and how do you think that advisors need to look at repositioning a part of their business?
I don't know how, because I'm not doing it. So I haven't handled that, but as far as back-end is concerned, we do have a technology in terms of reporting, etc. Analysis also, we have it, but customer interface and all, whether it's investing, whether it's overall planning, we don't have that, because the customers who are coming to us or who have been with us for more than 5, 10, 15, 20 years, they still want to talk to us. They still want to meet us. They are fine on a Skype call or a video call. And hence, we have not even looked at that. So I don't know what kind of technology, cost, what needs to be brought in, because we have not even explored that.
So basically, I think, from what we hear from the panelists, I think both models can easily coexist.
Yeah,
and
obviously.
I really do believe that, at some point, the value that you can show as an advisor does really impact the customer's willingness to use technology himself or herself.
I completely agree, Mrin, because what happens is a simple thing like a virus spread. They won't talk to somebody and say what will happen to me. Things like any political situation, things like market going up and down, regulations, they want to talk to somebody who will reassure them that, look, it's the overall planning that's happening. Second thing is elderly. When they come, they are saying, no, we want to talk to you. We want some human beings. When they call, they want to talk to individuals. So to that extent, the entire thing saying that just put it on technology, I'm not too sure how to handle emotions of a client. And I've been in this profession for last 20, 30 years. And I firmly believe that whether it's financial planning or wealth management or family office, or whatever name you call it, it's not about money. It's completely about the human emotions that arise in a mind of an individual when it comes to money. So unless that's not handled, because all these emotions of fear, greed, panic, jealousy, insecurity, how do you handle that? And if that's not handled, then the customer loyalty, the consumer loyalty, the investor loyalty, churning of portfolio, all those things happen because there is nobody talking to them. And if they are not able to talk to the advisor, then they'll be listening to somebody else.
Yes.
And that's where the problem comes, because they're going to vent it out somewhere.
Yeah.
And then it goes in wrong direction, wrong advice coming. And that's where the problem begins.
So Abhishek, I'd like to ask you that everybody is looking at, I think a lot of the platforms or a lot of the digital investment advice that exists is really focusing on millennials as a generation. But the truth really remains that it is the people who is above 40 who really have the money, right? And so what do you see as their willingness to adopt technology? Because from what Gaurav is saying, and I kind of concur with that beyond a point, you do need the human interface. So what do you see with clients above 35, 40? How comfortable are they with just using technology?
Yeah, so we at Abans Investment and Wealth Managers, see, let us understand what is wealth management. It is not managing just the finances of a person who has reached 40 and who has, or 50 and who has earned 1,000 crores. See, if you have made 1,000 crores, whether you make 12% on it or 14% on it, I don't think so. It makes a material difference. What we believe the philosophy of wealth management or true wealth management is that the first generation should make sure that the second generation is wise enough to handle that wealth. And I suppose if that wisdom is being transferred or that sanity is being transferred, then I suppose the second generation will take the right calls whether to whether to adopt robo advisory or personal advisory or which wealth management firm or what wealth management firm. So I think so truest wealth management, if you say, truest wealth management in its real essence is to make sure that the correct wisdom and the intellectual property is transferred from the first generation to the second generation, where you talk about the millennials. A millennial with having less amount of wisdom and having the greatest robo advisory is also a not fit combination or a proper combination. So I think so a robo advisory can be used only if even in millennials, if their financial literacy is very high, and that is why it works in countries like US, where that financial literacy and financial knowledge and know-how is much higher, and you can have time to fill out these forms. These are complicated forms to write on, like what you want, how much return you want social aware companies, or you want. It's not easy to adapt to it, even for the millennials who are not financially literate. So mixing the two, maybe, like, obviously this is the new trend going forward, but wealth management, I suppose, leaving just on robo advisory could be a dangerous tool. So it requires the human intervention of not only advising the products, but also transferring the requisite wisdom and the intellectual property from the first generation to the second generation, is what my philosophy and our philosophy of wealth management is.
And Rajesh, talking about generations of families, I'm sure you're working with families where there are various generations. So how do you then balance this whole bit out? Because obviously the older generation is quite averse to using technology, whereas the newer generations are. So what is the sort of balance that you think you can get in there?
Yeah, I think you are right. I think there is with I think generations ease of usage of technology, etc. There is first generation to second generation. We have that challenge. But of late, what we are seeing is, I think the second generation is also appreciative. It is not only having facts in front of them, it's also actually contextualizing it and structuring according to the situation. That also, because
so are they willing to listen to the advisor of the first generation?
yeah, one is listening to the the other thing is that challenge is there, no doubt about it. But they tend to actually prove their point at a very given opportunity. But when advisor, actually the importance of advisor, they are also appreciative of it. They appreciate they are good at particular their own area of business they are into, and the value add advisor brings to the table by interpreting and by explaining why a particular thing has to be seen in a particular way. That is there. I think yes, we are seeing certain amount of maturity. People are valuing advice and expert advice. That is there. Yes, they have it. They have a point to say. They have a point to put across. But the thing is, they are appreciative of the value add brought to the table by the advisors.
Okay. And Vivek, you were mentioning about how you're progressing on the products front, right? So I do see a lot of online platforms getting products like peer-to-peer lending or pure lending products, right? Like Insta loans and stuff like that. And obviously these are not right, and these are not right for customers. I mean, if someone's paying 40 to 50% interest, or even a peer-to-peer lending product is not a product for anybody and everybody. Yet a lot of people invest into it because of the high returns associated. So if you are with an advisor, of course the advisor is accountable. How do you manage the accountability aspect as a robo-advisor?
So we don't advise peer-to-peer lending to our
As of
clients.
now.
We don't intend
Yeah, but
to.
I'm just asking you from an industry perspective. I mean, you may not be doing it, but there are many other platforms which are now doing
So
this.
see, I think we need to understand the segments. So I think Abhishek rightly pointed out, and he also gave an example. So first of all, I don't expect any 1,000 crore investor to come to my platform and invest in my
No,
robo
you
advisory.
don't. But, I'll tell you something. Like today, if you look at peer-to-peer lending, right? There are a lot of people who just want to go there simply because of the high returns. And at the end of the day, you don't have a very high minimum entry barrier out there for someone to start investing there.
Yes, but I think RBI has put some caps. I think it's
There's a cap, but
10 lakh or 20
yeah,
lakhs now.
that's
I
a
think
cap,
they've changed
but
it. Yeah,
there's no.
there's a higher cap.
Yeah.
And the interest rates are around 15%, 16%.
Yes, yes.
So, I mean, see, as I said, there are a lot of customers in the investors in this country who come from a wide range of.
So let's take the example of an NCD, for example. You may not be having it, but there might be other platforms having NCDs, right, where the entry is not so high. So again, how do you manage the accountability aspect?
So I think it's for the advisor to actually, figure out the segment that they are referring to. There are a lot of advisors who are actually recommending, and I'm not talking about robo advisors, but offline players who are actually recommending NCDs to their clients.
They are, but I'm just saying there is an accountability aspect out there.
Absolutely.
So
Yeah.
how does the customer manage that with a robo advisor?
So see, I think from a robo advisory perspective, if you ask me, I think the whole idea and the kind of clients that we are dealing with and we are trying to get onto our platform are clients, as I talked about, who are new to the business. These are people who are trying to have some long-term, invest for their long-term goals, for their children's education, for their retirement, for, let's say, for a house or for a car 5 years down the line. And we are actually helping them with their small investments and letting them to invest in the right products and the right asset classes, right? But you are absolutely right that let's say, for instance, an advisor has to have the accountability of giving the right advice to the right client, and hence risk assessment becomes very, very important. Some of the platforms are doing it. Some of the platforms are doing it very well. Some of the platforms are beginning to look at this aspect more. I would say more closely, and I'm absolutely sure that as time evolves, we would also evolve. The robo advisory platforms will also evolve.
Yes.
Just to interject there, if you allow me. So, as you're saying that, how do you handle the accountability part of it if investor is showcased a product having a 15% yield in an unsecured NCD? We can't say whether the company will go bust or not, but we can present all the relevant data to the investor. This is the risk, these are the profits, this is what it is. So, to some extent, personal human intervention advisory is also to a certain extent like a robo advisory. Well, what else? A robo will also do the same thing. It will just detail the facts and figures, and it will make you aware of the financial product. But if you still think so, if the investor still thinks so, no, I think so, this risk I can digest, and this is my risk appetite, and if he wants to invest in it, go ahead with it. So, not even NCDs.
So basically you're saying that there needs to be a good amount of risk profiling that needs to be available
Absolutely.
as a check on these platforms.
So you can actually also handle this with asset allocation, right product selection, and diversification. So this is something that we also do, which I'm sure the offline advisors are also doing.
Yeah.
Okay, so I just wanted to talk about certain tools which are available overseas. There are a lot of these AI-powered tools which basically help advisors to improve the value of their advice. So for example, there's something known as InvestNet has an Envision IQ tool, which lets advisors ask questions such as, what happened in my client's portfolio last week, for example. And these are basically voice control tools that advisors can use. Do you see such sort of tools emerging in India?
Yeah, I think machine learning based, these are all typical machine learning based AI tools being used extensively outside. In India also, actually, we started seeing such actually usage of such tools. But for that, I think my sense is the machine learning tools typically, I think, take certain situations and can actually, but as time passes, as I think market being dynamic, and for example, at this point of time, everybody is talking about the coronavirus and its impact. And further, people are contextualizing the last 5 viruses and how the markets have behaved. I think subsiding the impact of those viruses, how markets have bounced and how GDP growths have bounced. But is that exactly relevant at this point of time? I think if you use a machine tool kind of this kind of actually machining algorithms, etc., tend to actually use those historical trends. But are they really
Is it really required? Yeah.
I think that is a question mark. There is where I think advisor, as a financial advisor, you need to actually put certain caveats and you have to contextualize it. I think how the risk needs to be managed given that kind of situation. I think from time to time that has to be contextualized. And that is, I think, the kind of product sets. Also, it also varies with product sets. For example, what kind of product sets you could use for applying these algorithms.
So coming to product sets, I know, I do also see that overseas, a lot of the robos are also introducing their own savings products, right? Obviously, because investment costs on other products like ETFs and mutual funds have really fallen.
Yeah.
So do you see that happening? I mean, I'd like to ask Vivek as well. Do you see that happening as well?
Actually, globally, these AI tools were extensively used, not as much as in India today. Primary reason is that they actually, globally equities are, for that matter, even bonds, investments, typically done on passive mode, largely passive mode. I think it is a growth of the passive investing is also increasing. In emerging markets, more specifically in India, our passive allocation is quite low. It will continue to be low. To us, actually, people are of late started talking about, I think the manager alpha is narrowing, etc. I think it is time to move towards passive. We don't agree with that kind of thought process. Still, I think market has some space, some more room, at least for next couple of years. I think manager alpha will continue to be in place. So that is where I think the gap is. I think globally it's been extensively used with the machine learning kind of tools. And I think focus more is on asset value add coming from the asset allocation rather than security selection. In India, we are actually more than asset allocation, we give utmost importance to the security selection. That is the gap actually. Then this particular machine learning concept actually picking up and being a significant part of, I think, the decision making is still some time away to us.
On the AI front, there is a funny anecdote in the global markets, Whenever there was a movie of Anne Hathaway, it was released, Berkshire Hathaway stock used to rally. So that was because at that time Anne Hathaway was searched a lot, and the AI tool used to say, okay, now Berkshire Hathaway looks under there's some news around it and there's some buzz around it, and just buy it. And then it took some years to figure that out, that it was because of Anne Hathaway's movies coming out that Berkshire Hathaway stock was going up. So just to put things in perspective, like AI is good, but you have to use these things appropriately.
Yeah, so since we're really out of time, I'm going to take one last comment from Gaurav and before I sum up. So Gaurav, price, service and quality. How do you think, in all your decades of experience, can you tell us how an advisor can really balance that?
It's difficult. It's tough, right? Because unless you are a large firm, a boutique firm will have certain amount of restrictions. At the same time, it's not that they don't survive. It's not that we don't take clients with lower income or lower paying capacity. So advice giving is a quality matter, and as long as somebody is ethically clear, that shouldn't be a problem. The issue comes with pricing. Yes, there would be certain amount of pricing that will have to be paid if you want a personalized advice. And to that extent, yes, it's a challenge, but I don't think there is an alternative because we are talking about human beings. Now, they also have to support the profession, their own family, and other things. So if you are saying that, can it start happening at the cost of what robo-advisors do? I doubt, unless they are large ones. So a boutique firm like me, we will face that challenge, but everybody will survive, and we will also survive.
All right. So with that, I think as the panel discussed, everybody will survive. There's space for everybody. There's a big market out there which is untapped, as Abhishek said. You as an advisor need to decide which tool, which way you want to go, the hybrid model, the physical model. I think there's space for everybody here today. But yes, cost constraints mean that you would need to adopt technology to a level, and it's up to you to really decide as an advisor as to what level you want to adopt technology to. Thank you. Any questions? Any questions?
bad that it has not ignited any inquisitiveness.
Or could be the reverse as well. But thank you so much to our panelists. And Mrin, thank you so much for facilitating that brilliant conversation. Thank you very much.
Thank you, Mrin.
I'm going to request our panelists and moderator to kindly exit from backstage. We would like to spend the next couple of minutes taking quick bites from you.